The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
AI skepticism, well, that's flipping to AI resignation as the buy the dippers out in force. Live from Studio 2 here at Bloomberg headquarters in New York City. Katie Greifeld, I'm Romaine Boston.
And I'm Katie Greifeld. Romaine made it safely back across from the river. Let's talk about what is going on in this market, though, because as Romaine mentioned, we're seeing those buy the dippers, as he phrased it, back in force. The S&P 500 higher by 0.8%, and it's big tech that's in the lead, actually. You can see the NASDAQ 100 higher by about 1.2%. A sell-off underway in the bond market. You're taking a look at 10-year Treasury yields higher by about 7 basis points. We got some hot ADP data out this morning when it comes to the private payrolls print. Maybe that's what we're seeing here in the bond market. And I wanted to highlight Bitcoin, of course. We broke briefly below $100,000 yesterday. That is a distant memory, Romaine. The Bitcoin, I sound like Tom Keene, higher by nearly 4%.
Yeah, the coin called Bit there, getting a nice little big here, and kind of funny to think about yesterday's trade here. Questions about that AI trade that played stocks on Tuesday really being shrugged off this Wednesday. Chip stocks, which dropped 4% as a group yesterday, clawing back the majority of those losses today in two of the most volatile trading sessions for the Philadelphia Semiconductor Index this year. Mira Pandit over at JP Morgan says investors better get comfortable with that volatility as the AI cycle is going to throw plenty of fits before it peters out.
So investors should still expect that there can be some volatility within this theme, even if the overall trend is to move higher. Because these are cyclical assets, as you guys have talked about here, we've moved from a very capital light industry to something more capital heavy. And there is a chip cycle. There is a CapEx cycle. I do think that these companies will be subject to the ebbs and flows of those types of cycles over the arc of time.
ARM Holdings and Qualcomm set to provide more insight on AI demand when they report after the bell. And we know as chip stocks and AI stocks go, so goes the market. An AI-related business investment trade that for now has allowed equity investors to ignore the worsening pain among consumers and that contraction in third quarter profits for consumer discretionary stocks not named Amazon or Tesla. In fact, when we talk about the economic environment, it's good to do so through the lens of the political environment. An off-year election last night that showed affordability was a driving force for how people voted, a testament to a K-shaped economy where top-line services and employment data reflect stability, while spending trends at restaurants and consumer debt delinquencies at 5-year highs, well, that suggests real pocketbook pain underneath the surface.
And you saw some of those details come through in McDonald's results, which is really interesting. It seems like there's more of a trade down going there when it comes to the consumer. But Romaine, of course, was speaking at length about the AI trade and how much that has defined this market. So with that in mind, I thought we'd take a look at just how top heavy your S&P 500 is. You're taking a look at the top 10 constituents to the index. You can see in terms of weight, they contribute 42.4% of the S&P 500's weight, just the top 10 companies. They also contribute more than 40% of the forward 12-month CapEx here. When it comes to net income, that number drops about 33.5%, and sales, when looking forward 12 months, 17.5%. So top heavy is the sort of theme here, Romaine. And when it comes to that AI trade, you think about some of these numbers behind me, we know how important that is to this bull market.
All right. Well, Niladri Mukherjee joins us right now, the Chief Investment Officer over at TIAA Wealth Management. And Neil, this has been a big topic of conversation right now, not so much as to whether we're in an AI boom bust cycle, but really this idea here as to whether you can get comfortable with the fact that that is right now the market.
Yeah, absolutely. It's good to be with you, Romaine, Katie. I would say this is the number one question we are getting from our clients, our investors as well, which is, are we in an AI bubble? There's a lot of investments that have gone into this space. Valuations are extended. I would say that if I look at this current situation objectively and compare it to previous instances of bubbles, there's a couple of things that stand out. There's similarities, there's differences. The circularity of the deals, that is something I'm keeping an eye on. I do think that's less about propping up each other's revenues. It's more to do with the interdependence, the strategic interdependence of the AI ecosystem. I'm also keeping a lookout for the tech companies, which are now tapping into the credit markets. Truth be told, the reality is that there's so much funding that is required for investments in this space that they will have to tap outside of their core cash flows into equities, into public credit, private credit, domestic international funding as well. But I think if I look at valuations, you mentioned it earlier, valuations are nowhere close to what we saw in previous dot-com era, for example. The tech index is trading at roughly a 30 times PE versus at the peak of the dot-com, it was at 58. And the profit margins are 20% today versus 10% then. So I don't think we are in a bubble yet. And in our view, the tech is in a long-term uptrend.
Yeah, there's no doubt about it, at least as far as income statements and balance sheets go. This is a much stronger cohort of companies than what we saw during the dot-com bubble. Though I am curious, the sort of circularity, if you will, Ouroboros, what did you say, Katie Griffin?
Ouroboros, so glad you asked.
Where basically all these companies are kind of just doing business with each other. Did we also see that during the tech bubble back in the old days? Because this seems a little bit more incestuous this time around.
Yeah, and I think it goes to how much close the AI ecosystem is and how much it is being driven by certain companies which have the capability, the expertise, certainly the funds to push AI forward and the people to do that. We did see some of this in the dot-com era as well in the term of vendor financing as well, but a lot of those financing actually went to companies which were not that profitable to begin with. And obviously when the stock market bubbled and the bankruptcies picked up, that just fed on itself. And I think this is a little bit different. To your point, these are highly profitable companies with wide economic moats throwing off a gob of cash flow. And I think it's a completely different environment. Again, valuations are extended. We know that investors tend to underestimate the impact of technology in the long term and overestimate it in the near term. So I do think that there'll be volatility along the way, and there'll be very many waves to this innovation, but the long-term trend is higher.
Yeah, and it's a good point, one that's been made before, that you think about some of the companies that are populating this bubble, as some would call it right now. They're very mature companies, and they certainly have profits to back it up. I do want to talk a little bit more about the economy. It's a little bit harder to judge where it stands right now in the absence of official government data, but we got ADP this morning, and it came in higher than expected and certainly better than the last print, which showed a decline. You think about sort of the interplay between inflation dynamics and labor market dynamics right now, Neil, and I wonder, where that leaves you, rather, in terms of where this Fed could go.
Yeah, I would say that the economy to us is, we've discussed this, the K-shaped economy is very much there. We look at numbers from Kava and Chipotle, and even McDonald's numbers would indicate that the low-income consumer is pretty stressed, whereas the wealthy income consumer is enjoying the benefits of higher asset prices. So that dichotomy very much exists. To us, the outlook for the economy is very much dependent on the labor market, as it always is, but also on the stock market staying afloat. So that is a little bit of a different dynamic than previous cycles, I would say. And the labor market to us is slowing down, but it's not cracking, to your point about the ADP numbers. And what we are seeing is prominent companies begin to announce that they're going to streamline their workforce, prominent companies like Amazon, Meta, UPS, et cetera. And there could be a number of things at play here. They could be getting more comfortable that they don't need to hoard labor. They could be exploring new technologies. They could be getting pinched on their profit margins. The bottom line is the labor market is slowing down. Inflation is still elevated. The Fed has cut by 25 basis points, but I do think Chair Powell has bought some optionality for December, where I think they will still cut, but there's a real plausible case to be made that they might pause after that. So generally speaking, I'm optimistic on the economy, but I do think the economy will move a gear lower as we go into 2026. There still would be the support from AI CapEx as well as productivity in 2026.
Absolutely, and it's an interesting point, too. When you think about McDonald's, the company is saying that when it comes to lower-income customers, they actually saw traffic drop there by nearly double digits. But I want to bring this conversation just briefly to a portfolio view, because you think about these different headwinds, these different cross-currents, these different potential tailwinds, Neil. Where does that leave you with the most conviction when you take a look across asset classes and sectors?
Yeah, Katie, I would say at TIAA, we lead with financial planning. We always recommend to our investors to be diversified across different asset classes. That's our number one conviction right now. And that also goes to having a diversified stream of income sources, which can help support their lifestyle during retirement. But what I would say is, given how far the equity markets have come and the valuations and the optimism already built into the bull case. I would say there's more volatility to come, but over the next 12 to 18 months, we're still optimistic on equities based on earnings and productivity. And within equities, I would say select areas within technology, utilities, and industrials, which are leveraged to the AI CapEx theme, are still the best places to look for alpha, including the electrification theme, which I think is just getting started.
All right, Neil, great stuff here. We've got to get you back on soon. Niladri Mukherjee, Chief Investment Officer at TIAA Wealth Management, kicking us off to the close here the day after a big election across the country, including in New Jersey and New York. The polls are closed, but the implications just beginning. We're going to have a conversation up ahead with Bradley Tusk over at Tusk Holdings, as well as Jeff Gural.
Plus, investors weigh in on politics and keep an eye on profits, with several names in the chip space reporting after the bell today. Bernstein's Stacy Rasgon gives us his instant analysis and his outlook on the space.
And of course, chips feeding into the AI revolution, a conversation with Jana Eggers over at Nara Logics. Stick with us. This is The Close on Bloomberg.
Social media stocks in focus in a big way after Pinterest's results left analysts feeling disappointed. The stock seeing its biggest intraday drop since 2022. Snap shares, too, also falling as the photo-sharing platform prepares to report third-quarter results next hour. Let's break it all down with Brad Erickson. He is internet equity analyst over at RBC Capital Markets. Brad, great to have you with us. Let's start with Pinterest because, boy, what a wipeout. The share's down about 22% at the moment. In your view, taking a look at the numbers and then listening to the executives on the call, what stuck out as the biggest problem here?
Yeah, now prepare yourself. I know you're going to think what I'm about to say is crazy, but the numbers were actually fine. I don't actually think even estimates for a lot of the buy side are changing today. I think the setback was really, the source of it was kind of communication. I think investors felt blindsided by the fact that tariffs are having at least a little bit of an impact on the business. And no one was prepared for that, I guess, coming in. So I think that's the major setback. But with that said, we've maintained the buy rating just because the valuation is super cheap now. And like I said, numbers actually didn't go down very much last night. So.
Right, Brad, I was going to bring that up. You take a look at Pinterest. I mean, in terms of the whole analyst community, it has 33 buy ratings, it has 10 holds, it has 0 sells, at least when it comes to the analyst track by Bloomberg. You, of course, are one of the buys here. Talk us through your conviction here. The reaction here very sharp today, but what would you need to see? What would need to happen before you would reconsider that outperform rating that you have on Pinterest?
Yeah, I think as kind of a way to guardrail the thinking, they've committed to a long-term target, 3 to 5 years, of a mid to high teens revenue growth rate. And they're kind of running right around the low end of that, so right around 15% at the moment as we look towards Q4. If we start to see signals into 26 where you're kind of going to drop materially below that, low teens, low double digits, to nuance the numbers, that's going to be a problem. The stock is very inexpensive. Like I said, it's trading at, I think, 11 times the street's numbers for 2026 and 9 times, I think, closer to that on 2027 numbers. So very, very cheap, downside limited, but you're still baking in, reasonable growth into those estimates. If we have to come off that, that's going to be the bigger issue.
I want to push ahead, Brad, to Snap earnings here. I know there's been a lot of talk about some of the challenges with the ad platform and whether they still have the pricing power that maybe they had in the past. What are you expecting?
Yeah, I mean, we think it's going to be an inline quarter. I think the issues that Pinterest is facing in Q4 probably are not affecting Snap. So I think, guidance should be fine, not great, but fine. I think the issue with them and what they'll be aiming to sort of communicate on the call this afternoon is that they are making progress both with sponsored snaps as well as improving measurement and getting better performance marketing outcomes. So that's, bottom of funnel is what they call it, when people are close to buying as opposed to just top of funnel brand advertising. They have struggled with that measurement. And Snap is tough, right? Because a lot of it is messaging. And so they struggle to know how to target when people message each other about all sorts of things, and there isn't really what we call topical consistency to that. That's where other platforms sort of know more about the users. They're trying to overcome that. I think at this point, we know they're making progress, but we don't have that high expectations coming into tonight.
All right, Brad, we got to leave it there. We'll catch up with you soon, I'm sure. Brad Erickson there is the internet equity analyst over at RBC Capital Markets. A closer look here at the earnings that we got a little bit earlier out of Pinterest, and of course a push ahead to those Snap earnings scheduled to come after the bell tonight. In addition to Snap, we're also expecting earnings out of names like Qualcomm, ARM, and Robinhood. Those earnings in less than an hour. A preview when we come back after the break. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. We start with Trex. Deutsche Bank turning bearish on the maker of decking products, downgrading to hold and more than halving the price target to $40 a share. The analyst says yesterday's earnings report suggests demand weakness may persist into 2026 and weigh on an acceleration in sales growth. Those shares having their worst day since the year 2000. Next up, Wingstop. North Coast upgrading the restaurant chain to buy with a $300 target. The firm confident Wingstop's new smart kitchen tech will help improve operations, consumer satisfaction, and store performance. Those shares, which rallied 11% yesterday, up 9% today. And finally, Pinterest. We were just talking about it. Rosenblatt downgrading on the back of the social media company's revenue forecast and user growth numbers that disappointed analysts. Those shares down 23% here on the day, and those are some of our top calls. While that is one of the big losers, let's turn to one of the big winners in the market. In fact, the best performing stock in the S&P 500 this year, it's Robinhood. User metrics are going to be a major focus when that company reports results after the bell. The stock has been one of the biggest winners, not only this year, but really going back to President Trump's election victory last year, gaining over 450% since. Dan Dolev covers the stock as senior analyst of fintech equity research at Mizuho. He's got to outperform, and he joins us here in Studio 2. All right, when you have this type of performance over this stretch of time, expectations tend to get a little bit elevated. So heading into tonight, what should those expectations be realistically?
I think a lot of the stuff we know, right? So they give you these quarterlies. We don't know September. We don't know like how October looks like, but we know kind of two-thirds of the quarter. Mm-hmm. We know equities was really good. We know options was really, really good. Crypto is kind of what it is. You know, it's sort of traded below where it was in the second quarter. And we know some of the metrics on like the users, right? What we need to pay attention to is gold members. That's a key thing. Mm-hmm. Inflows, right? So they've been running at a very high percent inflow. I think it was 44% as a percent of Schwab's like net inflows. Kind of if you compare them to sort of their established competitor. We want to see that number stay elevated. And most importantly, we want to see those new things, right? Kind of, we talked about social, we'll talk about it in a little bit, but we didn't really talk about, you know, sports betting, prediction markets. Well, that's the key.
Well, let's go there here, because we talk about a company that basically just started out as a way to trade stocks. And even then, it was a limited number of things you can do there. It's kind of become a one-stop shop. So let's talk about prediction markets, because obviously this is becoming a big entry point for some of the established players as well as new players who are now in the market challenging it. How far do they go with that?
This is unlimited, right? This is the beauty of this. Like, take a step back. Like, they're looking at a $600 billion TAM, and I think prediction market is in addition to that TAM. That wasn't even part of that TAM. Okay. This could be unlimited because not only prediction markets, you could use it for sports, you could use it for betting on the weather, betting on like Mamdani versus Cuomo, but you can also use it for hedging, right? So prediction markets, there's this like, you know, 2/3 of prediction markets, like the iceberg, that we don't even know of in terms of use cases. It could be used. So not just users, but like hedge fund can use that as a hedge against their thing. So this is almost unlimited TAM opportunity for Robinhood.
Yeah, it's fascinating. Just seeing prediction markets sort of, I don't know, be the blob that eats everything. We know that Robinhood is looking at expanding outside the U.S. as well when it comes to prediction markets. I actually want to talk about social media, though, because there's so many different avenues that it feels like Robinhood is pushing in right now. We know that they're exploring creating a social media feed where users can post their trades and also follow other investors. You think about the network effect that could create for a site like Robinhood. How do you even begin to model that?
So the way to think about this is a great question. The way to think about it, it's the same, you know, I'll answer in the same vein that we did for prediction market. What you'd find is a lot of people that post on social media their trades are the same people that are trading on apps like Robinhood. So that Venn diagram looks like this. By the way, same thing looks for, if you compare them to like DraftKings, et cetera, we've done research on it. It's the same people. So why not just sell them everything in-house, one-stop shop, instead of having them go somewhere else? So I think that's the opportunity there. Robinhood's really smart. They're seeing that and they're saying, why don't we just keep these people in-house and let them comment on their trades here, instead of having to go to, say, like Reddit.
Yeah, or a Wall Street Bets on Reddit.
Correct.
Yeah.
Yes.
So in the spirit of Robinhood expanding in all,
still around?
StockTwits is still around. I haven't spent
They
as
kind of
much.
missed their mark there. They should have become a trading platform.
Wow, I hope they're watching right now.
What about MySpace?
What about MySpace? God, what about Snapchat?
I don't think anyone knows what I'm talking about, right?
I had a MySpace,
No,
actually.
our audience.
Oh, yeah, that's true. I don't know. Write in if you were on MySpace. Anyway, let's talk about Robinhood as it relates to mortgages,
Yes.
because they announced an exclusive agreement with Sage Home Loans. What exactly does Robinhood have to add to that conversation? What's the ambition here?
26 million funded accounts and counting on a growing globally. So they're the funnel, right? They're bringing in originations. And so what they need is a partner like the partner they did. And we don't know the exact economics, but it's so powerful because if you think about it, at the end of the day, it's like last famous words of the day. At the end of the day, everybody wants to be your bank. Because they want your paycheck, right? And Robinhood, at the end of the day, is actually becoming a full-fledged financial services company. So why not offer mortgages? Why not offer, a car loan at some point? So all these things are coming, and it's purely incremental to that $600 billion TAM. And that's why I'm so excited about it, even at these levels.
Well, even at these levels and what levels they are, Dan, really great to get some time with you ahead of those earnings. That is Dan Dolev. He is Senior Analyst of FinTech Equity Research over at Mizuho. And just taking a look at Robinhood's performance year to date, it's pretty astronomical, Romain, up 286%. On a total return basis.
Yeah, and we talk about this idea of an expanding company and expanding market, and maybe that actually helps even bolster the valuation further.
Absolutely. Well, we'll get more context after the close today. But coming up, Democrats back on top in several states and New York City after last night's elections. We've got top venture capitalist Bradley Tusk, as well as storied real estate developer Jeff Gural, standing by to assess the impact. Those conversations next. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Katie Greifeld. Of course, we are fresh off in election day. Local elections in many places. You, of course, spent a lot of time in my home state of New Jersey yesterday, where there was a gubernatorial race. Yeah, there was a lot of drama in that race. And of course, a lot of drama right here in New York City, as a lot of people really sort of starting to look at what is basically the financial capital, if not the U.S., or potentially even the world. And the idea that it's going to be run by somebody who is decidedly not a capitalist. And now you have a business community that's going to have to reckon with this leadership and how you balance out some of his campaign promises with some of the economic priorities that they would favor. Yeah, and to that point, there was a really interesting note out from TD Cowen this morning, basically saying that you take a look at financials, that they face a, quote, populist risk after a Democratic sweep. You think about what we saw in Virginia, in New Jersey, and right here in New York City, certainly a win for the Democratic Party, which sorely needed it. So let's discuss this a little bit more. What is going on in New York, the capital of capitalism, with our next guest, who is a prominent venture capitalist with deep roots in New York politics. He's published a series of Substack posts this morning on the implications of Zohran Mamdani's win. His name is Bradley Tusk, founder and CEO of Tusk Holdings, joining us live. And we should note that Tusk was campaign manager for our founder and majority owner, Mike Bloomberg's 2009 mayoral race. So Bradley, great to have you with us here in 2025. Let's talk about what we learned last night about the Democratic Party and the future of New York City. Zohran Mamdani, the mayor-elect this morning. As I mentioned, you recently published this morning a Substack offering some pieces of advice for Zohran Mamdani. I thought this point was interesting, that this is your legacy. This is not a stepping stone. Explain to us what you mean by that.
Yeah, sure. And thanks for having me. No New York City mayor, including, unfortunately, Mike, has ever won an election for anything after being mayor. People have run for president, for governor, for Congress. They have all lost. So being mayor of New York City, I would argue, is both the single best job in politics, but also it's a dead-end job. And so rather than governing for the next election or for something you want to run for in the future, to the extent that Zoran can do what Mike did at City Hall, what I saw him do at City Hall, which is just make every decision based on what you truly believe is best for New York. Any given person may agree or disagree with you on any given issue, but I think the reason why Mike was a very popular mayor at the end of the day is because he genuinely did what he believed to be right at all times, regardless of the politics of it. And that actually worked really well. So I would hope that Zoran would be willing to govern in a similar way.
Well, when it comes to the success of any politician, one of the key determining factors is who they surround themselves with. And it's early days, of course. Zoran Mamdani just won last night, but so far we've learned that ex-Federal Trade Commission Chair Lina Khan has been named to his transition team. We've heard a little bit when it comes to folks working in New York City. We know that Police Commissioner Jessica Tisch reportedly has told her confidants that she will work with Zoran Mamdani, continue to work here. I wonder so far of these early reports, what you make of them in terms of the team that's being built around the mayor-elect.
I mean, so far, so good in the sense that what you want is to maximize talent around you. Another reason why Mike was a successful mayor is he just hired the absolute best people he could get for absolutely everything, just like you guys got hired. And when you put really, really talented people in roles that are meaningful and you give them the freedom to do their jobs well, they will frequently succeed. And, many ways, I remember Mike used to say, I don't care if someone's a communist, if they're the best person to pick up the trash, I'll make them sanitation commissioner. And I think the same thing is true here. It doesn't really matter if you are when you're the police commissioner or the sanitation commissioner or the buildings commissioner, what your underlying politics are. What matters is, are you good at doing those jobs? Jessie Tisch is exceptionally talented as being police commissioner. It's great that she is likely to stay. We can disagree with Lina Khan on FTC policy, on what does or doesn't constitute a monopoly, but that's not relevant to city government, right? For city government, tech is a question of what they might choose to use as an entity serving the people. It might be a policy question like, hey, are we going to let drones do building inspections instead of having scaffolding? But it doesn't get into things like monopolies and market power and whatever else. So Lina's unquestionably very, very smart, and I think it's great that she's there.
I am curious, though, Bradley, on this issue of, I know that there were a lot of sort of more national and geopolitical issues that came into this campaign. But as you point out, most people go to the polls and they tend to vote for the local issues, the things that really matter on a day-to-day basis. I am curious if you have any fear that Mamdani might actually try to interject some of those national and geopolitical issues into his day-to-day running of the city.
He might, but I think he will find that ultimately it's really not to his benefit. At the end of the day, the job is to pick up the trash, right? Mm-hmm. And if you do that well, the voters will appreciate it. And if you are busy waxing poetic about geopolitics, your base might like it. But his base is a relatively small group of people. I mean, even if you take the total votes that he got in the election, we're still talking about, 15-16% of the city's total population. So at the end of the day, if he's going to be a mayor for everyone, then there's really no need for most of the geopolitical issues. Yeah. And if you speak about Israel specifically, I disagree with him on Israel. I'm a pretty fervent Zionist. But with that said, there was an act of vandalism in a synagogue today. He came out really strongly against it. That's what he needs to do. He needs to protect Jewish New Yorkers. If he's willing to do that, I'd rather he be pro-Israel than not, but it doesn't really matter.
Yeah, and we should point out he did actually do a lot better with the Jewish vote, and based on what the polling was originally showing, that he was only going to track at about 10 to 15%, and pretty much doubled that. Also, I am curious about just the general idea of what the business community wants out of him specifically. And I actually had a chance yesterday to catch up with Stephen Fulop, formerly of Jersey City mayor, who's going to be head of the new partnership for New York City. And I am curious just about this idea of these CEOs coming together, not only trying to chart a path for themselves, but what they then walk into City Hall when they have a chance to speak with him and his administration, and what they really are going to put on the table for him.
Right. I think one of the challenges that a lot of CEOs and a lot of people on the private equity and hedge fund side have when it comes to city government is they don't really understand how it works. Like, Mamdani is a socialist. I'm a venture capitalist. Literally, the word capitalist is in my job title. And yet, it just doesn't matter, right? The main impact that the mayor of New York City has over the local economy is the city clean and safe and well run? If it is, businesses come here, tourists come here, the city does well. And if it's not, the city does really poorly. He doesn't control interest rates. He doesn't control the supply chain. He can't even raise taxes without Albany's consent and permission. So as a result, one of the things that I'm encouraged about with Steve Fulop is he's been a mayor. He understands what municipal government is like, and he can try to translate what the business community cares about into tangible policies that matter in New York City. But the bigger thing, I think, for Fulop and those CEOs is they really need to do a better job building a political structure for the business community in New York. We don't have that. So when Mike was mayor, the truth is we didn't need it because between Mike and all the people around him and all the resources, we could all do it ourselves. But he hasn't been mayor now for 12 years. And the far left, as much as I disagree with them, does things like recruit candidates, train candidates, do grassroots, do policy work, all of these things that then translate into people winning elections, first for things like state assembly and then eventually for things like mayor. And the business community does absolutely none of that. The only thing they do, if they do anything at all, is they panic and throw money at Andrew Cuomo or Eric Adams at the last minute, and that doesn't work. And so if Fulop can do one good thing, it's less about how he interacts with Mamdani one way or another, and it's about him building a real political organization and operation in New York City for the centrists, for the business community, so they can start to actually, compete in elections again.
All right, Bradley, I really appreciate your insights there. Bradley Tusk there is the founder
of
Tusk Venture Partners and a longtime political consultant and strategist, and as he alluded to, the campaign manager for Michael Bloomberg during his 2009 mayoral run. Of course, Mike Bloomberg, the owner of the parent company of the network that you're watching now. We'll be back in a moment. All right, real estate stocks tied to New York City have been all over the map today. A volatile session here coming on the heels of the mayoral victory last night by Zohran Mamdani, who seemingly came out of nowhere just a few months ago to take this city by storm. But of course, a lot of the proposals that he's put on the table to address housing affordability have rankled a lot of folks in the real estate community. And now, as we await the swearing in of Mamdani in about a couple of months' time, some big questions here as to how that industry works with them. Joining us right now is Jeff Gural. He is a titan in the world of local real estate, chairman of GFP Real Estate. Great to have you here, Jeff. Let's get right to it. I know you had a chance, along with some of your peers, to actually sit down face to face with the mayor-elect a few weeks ago. Did you hear anything out of him that gave you maybe a little bit more confidence that he won't necessarily be as bad as some folks in the real estate community have predicted?
Hard to say. I mean, I told him that socialism doesn't work. I explained to him that I had actually visited Romania when it was a communist country, and I saw firsthand how communism failed. The economy of Romania was in shambles. And if you recall, when communism fell, people chased Ceausescu up the stairs in his offices, and they killed him with their bare hands. So I've been to Cuba. That doesn't work. And he doesn't push back. I actually think he can be helpful. We've been trying to get the real estate tax assessments fixed because they're really disproportionately unfair to minorities in Queens and other parts of the city where their homes are overassessed and wealthy people's homes and apartments are underassessed. So we've been trying, and every mayor who's ever gotten into office has promised they'll fix it, and nobody has. I have a feeling he might fix it because it affects the people that he represents. I told him that I thought he should keep Tish as the police commissioner. He was non-committal at the time, but as you know, he's come out and said that he's offered her the job. I have no idea whether she's going to take it. I think her father doesn't know whether she's going to take it. Yeah. I would imagine the only way she takes it is if it's on her term. So if she says, "Look, I'll do it, but I'm calling the shots," Whether he's going to say okay or not, I have no idea. But if he kept her, that would be really helpful to our industry.
Well, that gets to the issue, too. I mean, we talk always about this economy through the lens of real estate and Wall Street, et cetera. But as we all know, for most New Yorkers, including business leaders, it all really comes down to public safety and the people, the perception, at least, that people have when they walk down the street, that they can walk down the street and go about their daily lives. With Tish there, and there have been media reports that she has apparently said that she will commit to staying. With Tish there, assuming that she has some sort of continuity, and the public safety issues are addressed, do you think that some of his attention will actually turn to a better relationship with real estate development? Because even before his election, a lot of real estate developers were grumbling just about how difficult it was to break ground on new projects and to see those projects to completion.
Well, I think you're exactly right. That was the one thing I told him, and he agreed. I said, for us, public safety is number one. We can't relocate our buildings. If companies here feel that their employees are not safe, they can move. So public safety for us, and he controls public safety, because the one thing he does control is who the police commissioner is and what instructions he gives the police commissioner. So I think I'm optimistic that he gets it, because just the fact that from the time I met with him, which was maybe 3 weeks ago, and recommended it where he was non-committal, he changed his position. And I think that's the most important thing. A lot of the stuff, some of the things he can be helpful on, because we all want to build affordable housing. So the fact that he agreed to pass vote yes on some of those questions that were on the ballot, that'll make it easier for people that don't have to worry that one city council person who's in a district can do a John McCain and go thumbs down and the project dies. And we've seen that over and over again. So now that's out the window. I think I'm not in the housing end. I'm actually partnering with a group on an affordable housing project. So maybe he'll help. I mean, the people who are really hurt the most, are scared the most, are the people who own, rent stabilized buildings, right, where he's saying no increase, no increase. That's crazy. We all know that the price of labor goes up, real estate taxes go up, insurance goes up, and you're just telling the real estate owners to just forget it. Sorry, that could be catastrophic, because you're seeing, foreclosures already.
Well, Jeff, I'm curious, what you see the relationship with Mamdani looking like going forward. Because, for example, Ralph Schlosstein, who ran Evercore and co-founded BlackRock, he told Bloomberg News that he's thinking about and exploring joining a business advisory group that might interact with the mayor-elect. Is there any sort of similar conversation underway when it comes to the industry that you sit in with your peers in the commercial real estate industry?
I'm not aware of it, but you'd have to talk to the Rebney, because he would reach out to Rebney, who was really the parent of that's our organization. But look, think about it. He's somebody who got elected. I asked him. I said, did you think you could win when you started? And he said, yeah, I told my wife I was going to do this. I told her I couldn't win, but I might be able to get at least my point of view out. So he had no idea that he could possibly win. Obviously, it helped that he wasn't running against, Andrew, unfortunately, is capable, gets things done, but it's not likable. Let's be honest. People who donated to Andrew, myself included, we're not big fans of Andrew. We just gave him money in the hopes he would beat Mamdani, because he gets things done, and we didn't have to worry. As far as Mamdani is concerned, the jury is still out. But he didn't. When I met with him, I spent about a half hour one-on-one, really. He didn't push back, and say, oh, no, you're wrong, Jeff, socialism is great. And so I think the reality is the number one thing for us is public safety. He knows that. And if he fails in that regard, he'll be a one-term mayor. And Trump, will be able to point out, we're going to have to send the federal troops into New York, because look what's happened when the Democrats elected a socialist, anti-police, et cetera, et cetera, et cetera. So, it's critical he's no fan of Trump's. I listened to his speech last night. And it's critical that he doesn't give Trump the excuse to say, "Hey, look what happened in New York. Everybody's scared to death. People are leaving." So he's a smart guy. Think about it. What would you have bet? Starting out, I don't think anyone took him seriously, and here we are. He had a terrific young people. My son lives in Red Hook, and he told me he never had so many young people knock on his door, tell him to vote for Mandami. Yeah. And that's what I guess they call that ground game. Yeah. But that's the kind of look. I'm a big. If we don't solve this problem of income inequality, I think you'll elect a socialist as president. Probably not in my lifetime. Yeah. But we have got to address the fact that we have so many people that make so much money that I don't know what they could do with it, and it's hard to believe that someone who makes $1 billion a year would really care if his taxes were raised. I don't know what you do with what you do. Sorry. What you do with all that money. Right. But eventually, the wealthiest people in America are going to have to come to grips with the fact that they're going to have to chip in and agree that to increase taxes in order to. How about, think about it. I was shocked. They talk about, this food program, 40 million people benefit from SNAP. I think that's 20% of the population. Jeff. So, you have people who say, oh, it's, people who are migrants who are here illegally. 40 million people get SNAP benefits? That's crazy.
Jeff, unfortunately, we're up against the clock. Wish we had more time with you. Great conversation. We really appreciate your time. That is Jeff Gural. He is chairman of GFP Real Estate. Certainly a lot to sort through there. Meanwhile, we turn our attention back to these markets. Perhaps. We are 8 minutes away.
Yeah, Jeff is a great voice, and we should just point out, there was a lot of anxiety heading into this election, and there's going to be a lot of anxiety as we wait to see what those policies look like. But we turn back to the broader markets, and it's a market still pushing towards record highs, still on the back of that AI and tech trade. Yeah,
but certainly some of the steam coming out today. We have been talking about the buy the dip resurgence all day. It's still holding. We're still up 0.6% when it comes to the S&P 500. Yeah. But that is not close to session highs, and it certainly doesn't quite dig us out of the hole that we were left in yesterday. Yeah, quite a few earnings also after the bells that could change the complexion of where the market goes next. Qualcomm, Lyft, Figma, ARM, Bumble, Fortinet, AppLovin, and Robinhood, DoorDash, just to name a few. A big focus on earnings, and of course a big focus today on the state of the economy on the heels of that election that was largely driven by concerns about affordability, the absence of official economic data, and that private market data that continues to come in and continues to paint a mixed economic picture. Kathy Entwistle joins us here in Studio 2, Managing Director and Private Wealth Advisor at Morgan Stanley Private Wealth Management. Kathy, great to see you here.
Great to see you guys.
I want to start on the economy here because, we know on the surface everything looks good, but some interesting comments by Scott Bessent seemingly suggesting that they're seeing signs of pockets of a recession, not a broad-based recession, but pockets of the economy in recession. And we've heard this from other economists as well. The question I have for you is, when, if at all, does that actually start to affect financial markets?
Well, it can definitely affect financial markets. And I think we saw even a little bit over the last few days where people are starting to get concerned. And even with ADP numbers out earlier today, it was really about the large public companies, really, that were doing well with jobs, and the smaller and mid-sized companies are not growing at the same pace, and that is where we start to see a little bit of the cracks first, typically. So I think that it will eventually affect the markets, but we also know that the markets are long-term, and when they pull back, it's an opportunity to buy.
Well, where exactly, though, is the growth? When we look at publicly traded companies, and I'm basically talking about top-line revenue growth. Obviously, we know it's coming from the Microsofts and NVIDIAs of the world, but once you get past those names, I was surprised, someone over at Bloomberg Intelligence sent me something that actually showed if you look at the consumer discretionary sector and you exclude Amazon and Tesla, which obviously distorted a little bit, you basically had an earnings contraction there right now in those names for this quarter so far.
Growth of employees versus growth of the business. Yeah. And I would say absolutely, we have been looking at that for the last year plus. It's the large 7 names that are driving the markets, and the rest of the market is really just sort of hanging in there by by a thread. There's definitely some cracks there.
So some cracks forming. I wonder how this informs how you're thinking about the equity market right now. We've been talking about this narrow leadership. You occasionally get days, such as today, where breath picks up a little bit, but it feels like all of the action just continues to be in these tech giants. And I mean, as an investor, how do you play that? Do you just have to dance while the music is playing, so to speak?
It's funny that you said that about dance, because I'm thinking like one step forward, two steps back, like you're kind of playing it back and forth. And in terms of, we've seen a lot of clients really build up some big positions in those larger names, and their portfolios have gone up quite well this year. So what we're trying to do is, when I think about it, typically we might have 60% in equities, just generally. And I would say I would be targeting more of a pullback and coming back down to about 50%, slowly moving out of some of the equities and going into other areas that might be a little bit more boring.
Interesting.
But also will weather some storms that may come if we do see some sort of a recession.
Well, we like boring, so give us some more color there. 50% equity, what do you replace that 10% with?
Yeah, some of it is going to be, well, some of it's going to be cash, right? So, and cash should be used only for two reasons. One is to take opportunities when the markets do have some pullbacks to go in, and you really have to be ahead of the game there. You have to know what you want, and you have to be willing to execute immediately on it. You cannot think about it, you just do it. So you have to have a plan. So you have cash there on the sidelines just for that. And then you also are looking at fixed income. Municipal bonds still are a good buy for clients, and the tax-free nature, depending on a client's tax rate, could be a 7 to 8% return, which is not so bad. And then, of course, alternative investments have really played a key role, along with commodities for clients.
Yeah. Do you think that's going to hold up, particularly with the alternatives? I mean, there's been a lot of talk about the outsized returns, at least on a relative basis to other asset classes, and the idea that that gap has narrowed as, those days of just where you can just count on 15 plus percentage point gains, that's long gone.
Yeah, well, there's different types of, when I think about alternatives, I think about like the general markets, and there are alternatives that mimic the equity markets, and there's alternatives that mimic, the credit markets, and being able to navigate that a little bit and think about investing along in that respect, like you're going to have some of the fixed income or the credit side of it versus the equity side as well. And I do think that there's still opportunities there. I do think there's still some great ways to invest. And also with the evergreen nature of alternatives today, where it's more geared towards the individual investor versus institutions and foundations, you can leg in, and you can also be more nimble if you need liquidity.
Right. Well, you mentioned credit, and I actually want to talk specifically about credit, because we were talking about tech as it pertains to the equity market. We know there has been a ton of investment grade issuance when it comes to some of the tech corporates there. I wonder, does that appetite for high quality, large cap sort of names, does that extend to the debt market as well?
Great question. So, when I'm looking at credit for clients, we're always looking for investment grade credit. We do not want to go dip down into higher yield, because you're not getting paid for it, and it is risky. And if you go back in time and in history and look at different times in the markets, the times where you're getting challenges is when we're like heading into recessions or things like that. So it's a good time to avoid high yield, and it's a great time to invest in investment grade.
Kathy, you have to leave it there. Kathy Entwistle, Managing Director, Private Wealth Advisor at Morgan Stanley Private Wealth Management, counting us down to the closing bells. A check of the clock tells me we're just 1 minute away from those bells and 1 minute away from a slew of earnings.
Are you excited?
I am actually excited. I don't know if I told you this. I was out in New Jersey yesterday.
I heard that.
Election.
I was extremely
outside
jealous.
all day, on my feet all day. 6 in the morning.
But you did
sundown.
it for the fans.
Yeah,
so.
I did do it for the fans, but it's nice to be back in the studio, nice to be back to covering markets. And I want to talk about Qualcomm.
I want to talk about it too.
I mean, that's going to be a huge portion of this AI tech trade, and whether that continues. Got a little disappointment yesterday out of Supermicro.
Yeah, indeed. Yeah, we also had a slew of earnings yesterday. It'll be interesting. It feels like we definitely had some hiccups when it comes to the proper mega caps, the Magnificent Seven. We came out pretty well on the other side, but when it comes to sentiment, we know it's a fickle thing. So really sort of upping the urgency when it comes to the results that we'll get in just a few minutes.
That includes MetLife, Allstate, AMC, Snap, DoorDash, and Robinhood, the best performing stock in the S&P 500 here in 2025. The closing bells in New York with green across the screen, a big flip-flop from what we saw yesterday. The Dow Jones Industrial Average up about 0.5%. The S&P up 0.4%. The NASDAQ indices each up about 0.7%. And the direction of the NASDAQ and the S&P could change based on what we get out of Qualcomm and its earnings report.
And speaking of Qualcomm's, we do have those Qualcomm figures right now. Let's start with the look back when it comes to fourth quarter adjusted EPS coming in at $3. That is slightly better than estimates of $2.88. Here is the red headline on the Bloomberg terminal. This is the look ahead. First quarter revenue Qualcomm sees coming in between $11.8 billion to $12.6 billion. That range compares to estimates of $11.59 billion. So certainly a boost there, coming in better than expectations. You can see Qualcomm shares currently down by about 1%, Romaine, even though, again, that revenue forecast did beat estimates.
Yeah, overall a 10% growth in the quarter year over year. When you look at the individual sectors here, the best performing sectors was in autos. That was up about 17%. And in handsets, of course, their core business up about 14%. But you keep an eye on some of the other businesses like QCT revenue, which is where a lot of people see this company's future, up 13% year over year. But kind of interesting, Katie, to see the shares. I guess we'll just kind of call them flat here. They've kind of been bouncing back and forth between gains and losses.
Yeah, and you think about sort of the context in which we get these results. Qualcomm shares up 19% year to date here. So not super high expectations as measured by share performance, but you can see traders deciding what to do here. You mentioned QCT. They did say that they delivered 18% year over year growth in total QTC, non-Apple revenues. But again, you can see a little bit of disappointment coming through here. I also want to mention CapEx, full year CapEx coming in at $1.19 billion, just a hair above estimates of $1.18 billion, but certainly disappointment working its way through the shares after hours.
Yeah, kind of interesting. A beat and raise quarter here for Qualcomm. Katie Greifeld, as we keep an eye on some other headlines crossing the wire. We're going to dive a little bit deeper into Qualcomm. We're also waiting on ARM as well to get a read on what's going on in the tech sector, but a big headline crossing the wire right now in the healthcare space.
Yeah, absolutely. This coming through. Pfizer denied temporary block on Novo Nordisk's bid for Metsera. We know that a bidding war has erupted between these two companies for this obesity startup, Metsera. Pfizer had tried to block that in court, get a temporary block. We're learning now that that has been denied. So Novo Nordisk's bid there, not getting that temporary block from Pfizer. Really interesting story that has been developing. I will also add that Novo reported earnings this morning. So a really busy day in the healthcare space, Romaine.
Yeah, it's kind of interesting, too. It'll be interesting to see how this merger, if you will, plays out, particularly given how politicized we've seen now this M&A regulatory process become, less about whether it actually makes good business and, well, good for the consumer, and more importantly about whether it fits in with the broader national agenda. Let's turn back now to the tech space. We were just talking about the beat and raise quarter by Qualcomm that was met with a bit of a shrug. Now ARM Holdings out, a big chip design company, out with its results for the fiscal second quarter, coming in on the bottom line, EPS at 22 cents per share. Now, when they adjust it, it comes in at 39 cents a share, and that would be a beat. The street was looking for 33 cents a share on average. Revenue also beats at $1.14 billion. The street was looking on average for just under $1.1 billion, which you point out gross margins expanded as well. What do you think ARM's gross margins are, Katie Greifeld?
Unfortunately, I have their adjusted gross margins right up in front of me. So
okay, all
your
right.
quiz, I'm not Carol Master. Your quiz won't work.
My quiz won't work. 98.2%.
Pretty good. Compare that to the estimate of 97.9%. Certainly a little bit better than expected here. I'll point out that adjusted operating expenses coming in a little bit lighter than the estimate. You pair that with adjusted operating income coming in much higher than expectations at $467 million versus the estimate of $385.5 million. You add it all together, ARM Holdings up about 4.5% after hours.
Yeah, I just want to mention we're going to continue to dive deeper into these earnings. I do want to just quickly mention some headlines coming across the wire from the Financial Times. Jensen Huang, of course, the CEO and founder of NVIDIA, talking about the AI trade. And in his words, he says China will win the AI race with the U.S. Dun, dun, dun. All right, meanwhile, back to Qualcomm. Those shares unchanged on the day, a beat and raise quarter, but maybe, I guess, the street was looking for a little bit more. Jay Goldberg covers this sector better than anyone else. He joins us right now, analyst at Seaport Research Partners. What did you make of the report, Jay?
I thought Qualcomm looked pretty good, right? Numbers look pretty clean. I'm still digging through it. I don't have a Bloomberg terminal, so I don't get the numbers as quickly as you all do. But it just at first blush, it looks good.
All right, we're going to work on that, Jay, by the way, getting you a Bloomberg terminal.
Yeah, I think part of the issue is the stock has run in the last 2 weeks because they announced their AI product, and I think that has people expecting some bigger upside. The AI product isn't going to be in the market until next year and isn't really going to be material until the year after that. So there are probably some people who are expecting some AI contribution, and this isn't the quarter when that's going to happen.
I think it's interesting, though. I mean, when you look at the traditional business, the core business, if you will, I mean, that looks like it's holding up just fine. And I would think that would be encouraging to investors, the idea that there is some sort of bridge between what they have been in the past and what they're trying to be in the future.
Absolutely. That's been the story of Qualcomm for the last few years, is they're very reliant on the cell phone business. Smartphones are now mature. Everybody in the world who's going to buy one has one. And so where's the company going to grow if smartphones are X growth? And they've diversified into auto, they've diversified into PCs, they've diversified into data center now. And I think all of those are, well, auto is trending well, PCs are very slow, AI is very much a show me story. I will say I have some questions about the core cell phone business, not near term, but longer term. I think they're starting to see a lot more competition there. And I wonder when the company's going to get a little bit more earnest in fighting that off.
Well, Jay, that's where I wanted to go, because you think about that increasing competition. It comes from the likes of Apple. We know that Apple is transitioning away from using its modem components. Instead, it's trying to build those in-house, those designs for modems. And I mean, talk to us about what that means for a company such as Qualcomm, which, despite wanting to transition, is still very reliant when it comes to that core business of smartphones.
That's right. 80-ish% of revenue comes from things that are attached to smartphones. And right now, 5 of the 5 largest handset vendors in the world have their own applications processor type of chip. 3 of the 5 largest handset vendors in this world have their own modem. That's another type of chip. Applications processor and modem, that's the ballgame. That's what Qualcomm sells. And you have the biggest handset vendors all looking to do their own internal silicon. Now, it's not urgent, right? They've held off this loss of Apple well. Some of those other products aren't great. But the trend is pretty clear. Qualcomm has competitive threats from its own customers, and they really need to address that a little more urgently than they seem to be giving up.
And so you mentioned that that's, of course, something that you would like to hear more from when it comes to executives. When it comes to the call, what else do you want to hear a little bit more detail on?
Honestly, I would like to hear a little bit more about how their PCs business is going. They launched it to a lot of fanfare earlier this year, and then they've gotten very quiet about it. I don't think it's tracking particularly well, but I'd like to see some update on how that's progressing. And automotive is another area. Again, it takes years for auto products to get deployed, but always, I think investors are always interested in what's going on there. What's the developments on that side?
I am curious, too. You also cover Seaport, and we saw for a while, Seaport, you also cover ARM. I am curious, Jay, I mean, we did see those shares pop initially on the back of ARM's release. The shares now only up about 2 to 3% right now. I know these are 2 completely different companies in terms of their focus in the ecosystem here. But where do you see ARM's fortunes going, particularly in the capacity of of this AI build-out?
ARM is super interesting. There's a lot going on right now. They have a new CEO. Well, he's been there for about 2 years, and he's really driven the company to capture a larger share of value from the industry. They create a lot of value, and he's been doing a good job of sort of doing all the things to get their value capture higher. The next step in that process is everybody thinks they're going to build their own chip. It's moving up a big step in the supply chain. And if they do that, their gross margins won't look as good. There's only 50% gross margin, but the raw dollars are much larger. And so, you can't take percentages to the bank. You can only take gross margin dollars to the bank. And so this is a big step for them. They've been investing heavily in it. It's very expensive. That's why OPEX has been so high and why we're all glad to see OPEX down a little bit this quarter. But we don't know what the product is yet. It's a big mystery. And everyone's curious what they're going to be doing.
All right, Jay Goldberg, great to get some time with you, some instant analysis when it comes to those breaking chip maker results. We'll have to work on getting you quicker access to those figures. That is Jay Goldberg. He is analyst over at Seaport Research Partners. And Romain, it just continues earnings out of Robinhood.
Let's get right to it here. Revenue in the most recent quarter, a beat $1.3 billion. The bottom line also a beat. Adjusted EBITDA, $742 million. The street was looking for roughly $727 million. ARPU also coming in at a beat at 191, though you are seeing some weakness here in the shares as we move forward. Crypto revenue did actually miss $268 million. The street was looking for $287 million. Options revenue relatively in line with estimates at about $304 million. And now, Katie Greifeld, I don't know if you're taking a look at this as well, but it looks like we have a new CFO coming in to the company.
Yeah, really interesting. Shiv Verma is being named as the next CFO there. Apparently Jason Warnick announcing his intention to retire. Really interesting to get this. Also, Robinhood, this is another headline crossing the terminal, not providing 2025 outlook for total operating expenses. You add it all together, maybe helps explain why you're seeing the downdraft in shares right now. It is interesting that they missed when it comes to the third quarter crypto revenue, coming in a little bit light relative to expectations. We know that the third quarter was certainly volatile for crypto, but I do want to talk a little bit about DoorDash here because you're seeing a pretty sharp reaction in the after hours trade. DoorDash shares down about 12.6% right now. I have to say that you take a look at some of the figures, they don't look too bad relative to expectations. Third quarter revenue coming in at $3.45 billion. The estimate had been for $3.36 billion. Their orders also in the third quarter came in higher than expectations to the tune of about 6 million. So you see, though, that the shares, certainly some disappointment working its way through now. They did say that they do plan to ramp up spending next year. That's after their third quarter sales growth is being picked up.
A 13% drop in those shares, meaning the complete flip side of that right now is Snap. Those shares up 17% here in the after hours trade after reporting earnings that appeared to have beat most of the main estimates for the current quarter, for the last quarter, excuse me. Third quarter revenue coming in at $1.5 billion. That was just a smidge above what the street was looking for. Daily active users also in line with estimates at 477 million. Here's the guidance going forward, and this seems to be what's pleasing investors. A 4Q revenue guide up 8 to 10% is the guidance that they are providing for investors here. And that does appear to be more than what the street was looking for. The company says revenue for the quarter will be in a range of $1.68 to $1.71 billion. The low end of that range is basically right around the average of street estimates. On a profitability basis, EBITDA adjusted, because everyone adjusts, 280 to 310. That's the range they're giving. The low end of that range of 280 million, Katie Greifeld, well above the average of street estimates of 255 million.
Interesting to see Snap shares just soaring right now. Really interesting company in general. Who is using Snap? I guess high schoolers, but we'll talk about that a little bit more later. But let's turn back to the chip space now and bring in Stacy Rasgon, senior analyst of U.S. semiconductors and semiconductor capital equipment over at Bernstein Research. Stacy, great to have you with us. You take a look at the reaction in Qualcomm. Shares down about 3%. The forecast was upbeat. I know that there was a U.S. tax change leading to a $5.7 billion write-down. Do you think that is what's working its way through shares right now, or is there something deeper when it comes to these results?
It could be, and I'm still parsing through the numbers, but I don't see anything here to be concerned about. It was a pretty solid beat and raise. That charge you mentioned was a non-cash tax charge. Hits GAAP earnings, doesn't hit pro forma earnings. They net it out. All the segments beat in the quarters: handsets, auto, IoT. The guide was actually really strong. It was, I don't know, $600 million above consensus. I mean, maybe people are just worried that most of the strength is coming from stronger Apple. And as I think you mentioned, I think Jay mentioned earlier, Apple over time is going to be rolling off. So maybe that's part of it. I don't know. But to my eyes, at least at first glance, like this looks just fine. So like we'll see how the stock trades through the print and into tomorrow. But at least at first glance, I don't see anything here concerning. It looks fine. Well,
let's talk about that a little bit more. How existential is the threat of Apple, building sort of these designs in-house, especially as Qualcomm attempts to transition into a business that is maybe a little bit less reliant on smartphones?
Yeah. To be honest, I would rather Apple just went away tomorrow and so we could just stop talking about it. Like, everybody knows, like it's not a secret. Qualcomm management has been 100% transparent how they expect, at least for modeling purposes, that ramp down to go away. It takes some time, right? It won't be fully out of the model until, end of 27 into the beginning of 2028. But it is starting, and frankly, at this point, I mean, like whatever, like we all know. I mean, you should be at least mentally taking it out of your numbers. It's one reason the stock trades cheaply, because you want to take it out. But I mean, personally, I think they're growing numbers like double digits ex Apple, and I think you're paying, even by the time Apple's out, they're still doing 11, 12 bucks in earnings by the time it's fully gone. Like, I think the valuation looks very, very attractive even without it. The issue is that optically it's a growth headwind. Like the EPS just kind of does this for the next 3 years because it takes time for it to roll off. But it's known. It's known at this point. I just wish we could stop talking about it.
All right. Well, we'll stop talking about it, at least for today. I think, Stacy, next time we have you on, we'll probably ask you again. But in all seriousness, this also gets to this idea. I know everyone's so focused on AI infrastructure, the build out, whether we're spending too much money on this or whether we're going to see a return. The chip makers, to a certain degree, seem insulated from that because they are the direct beneficiaries. But when you look at some of the earnings reports that we've got out of some of these companies, there does seem to be some cracks. The idea that the growth is there, but not necessarily to the same degree. What's that sort of plateau that we should be looking for?
I don't know that we've necessarily seen that, at least out of the chip companies. Like, so far, demand's been pretty strong, right? I mean, and we're still waiting on a few, right? I mean, Nvidia and Broadcom haven't reported yet. They come in a little bit. Their prior reports were very strong. AMD reported last night. Their near term, it actually has a pretty strong ramp, although I think expectations were higher. Like, the near term relative to expectations for their AI was a little muted. But I mean, for AMD, the story's not so much the near term, it's the OpenAI ramp, which happens in a year. And I mean, AMD presumably will talk about that a little more next week. They have their analyst day. But no, I wouldn't say from at least on the chip side that we've seen any signs of slowdown. I think far from it. Like the demand, at least at this point, still seems to be there and still seems to be pretty strong. On the supply chain side, I mean, we've had some of the server guys report. Again, the revenue is great. Like, the margins and some other things, on some of the other players, we'll see. It is the chip guys actually that seem to actually be extracting most of the economics. For my purposes, I guess that's a good thing.
So, Stacy, kind of put this in perspective here. So, as Qualcomm sort of evolves into whatever it's going to evolve into, what is the overall industry going to shape up to be? Because right now, you basically have NVIDIA on kind of the higher advanced chips. You have in the analog space, I guess, Texas Instruments still a giant. But obviously there's a bit of a sort of a reshuffling of the order afoot here. And I am curious as to where you see the ranking stacking up.
Just across the names, I mean, look, right now it's been kind of AI or bust. I mean, clearly the AI names have been working, and the analog names and the mobile names, like not as much. I mean, the AI guys sort of suck all the air out of the room. I get it. At the same time, I think there's room for lots of others. And again, I mean, you can take a look at Qualcomm, right? So smartphones in general have been out of favor. To be honest, their numbers have been fine, even in the midst of a smartphone market that hasn't been awful, hasn't been fantastic, hasn't been awful. There's an edge AI story that I think if AI does move more and more to the edge, they ought to be a clear beneficiary. And even Qualcomm now has, in some sense, a data center story. They are, they've made parts for a while, but they're making a bigger push on that. They've got a partnership with Humane. They made an announcement a couple of weeks ago. We'll probably hear more about that tonight. But there is even, to some extent, a bit of a data center story there.
Yeah.
But I think, at least from an edge standpoint, I don't see any reason why we shouldn't have AI not just in the data center, but also on the edge. And I think there is opportunity for some of these other names to catch a bit more of that narrative that so far has been isolated to a few of the more direct AI beneficiaries.
Stacy, always appreciate it. Great insights as always. Stacy Rasgon, one of the best in the business, senior analyst of U.S. semiconductors and semiconductor capital equipment at Bernstein Research. As we wait on that conference call from Qualcomm, the share is down about 3%. I do just want to pivot real quickly back to Snap. Those shares now extending their gains up more than 23%. And here's the headline: a partnership with Perplexity AI, a $400 million deal that will basically bring Perplexity's AI search engine to the Snapchat universe, a potentially new stream of revenue that a lot of people have been speculating about, and that appears to be why we're seeing so much strength in the stock, not necessarily on the back of those earnings, Katie.
Yeah, certainly. Quite a rally that we're seeing after hours. Apparently, Perplexity's AI-powered search engine will take default placement inside of Snapchat beginning in 2026. Snap's existing My AI chatbot will also be available to users, but it's Perplexity that will have the default position. Really interesting here. I have to say, I did not know that Snap had that. One of us needs to get on Snapchat.
Yeah, and of course, as we approach what is going to be the 3-year anniversary of ChatGPT being debuted to the public, let's bring in a pioneer in the AI space. Jana Eggers joins us here in Studio 2, CEO over at Nara Logics. Nara, of course, looking to sort of make AI a little bit more like the human brain, if you will, which actually brings me to this Perplexity deal and some of these other chatbots. I mean, I use them a lot. And I know there's a big difference between maybe what we see behind the scenes and what the consumers are seeing with AI. Most of the AI I interact with seems pretty dumb. Like, it doesn't actually seem like it has actual and real brain. I mean, it's good enough, but I don't really feel it's as transformative as maybe we have made it out to be. And I am curious as to when you think we might actually get there, or if maybe we're there and we're just not seeing it.
I think we're still waiting to get there.
Okay, yeah.
But it's not until people use it till we learn how to do that. So all of this interaction that you're doing and the feedback that you're giving, and that's going to help us grow. So thank you for doing that.
Okay. All right. Well, I'm trying to do my part, but I'm holding, in all seriousness though, because we talk about this from the perspective of the revenue that this could generate, and hopefully one day the potential profitability, as well as productivity improvements too. And I guess the question is, how far along are we? Because it seems like things got supercharged 3 years ago when ChatGPT came into the public consciousness. Everybody's throwing money at this in some form or another. Have we really moved the needle over these last 3 years, materially?
I would say yes, but it's more behind the scenes. It's not the interactions that you're having. That really hasn't improved. I mean, I was searching for which terminal I went to last night, and it said, oh, well, go to Terminal C. It's gate 70 through 99, and your flight is at gate 47.
Yeah.
So we haven't done so well with that. That said, there's a lot that's happened behind the scenes for better automation. So it does do some things that were a lot more paperwork before. It can actually do better with that and faster. And so I think that's what you're seeing, where you're seeing companies that are, not hiring as much because they are figuring out ways to really facilitate some more back-end automation.
I have to say, when it comes to these different chatbots that companies are trying to introduce, it feels almost like a rebrand, because chatbots have been around for a while. Think about some of the travel sites. There's always been some little helpful window trying to pop up and help you. So, I mean, what is the differentiation factor between what we're developing now versus what we were already talking about a decade ago?
It's really much more expansive. So the ones that we had a decade ago were, there's a lot more time that people had to spend on them to get them to where they were, and it wasn't that good. So you have a lot more flexibility now, where companies are saying, look at this, but do that with the perspective of understanding language better. And so it's that, imagine it's a better foundation than what people had before. So that better foundation allows them to move faster and provide a somewhat better, less mechanistic response. So you see people really having conversations with these chatbots. I mean, people are interacting, and that really wasn't possible before. It was usually you ask a question, and if it got it right, it was okay. But other than that, you're like, human, please, human.
Yeah, exactly. That sort of has been the thing, that people would just ignore the chatbots. Now they are really engaging and interacting. And as Romain mentioned, it's been almost 3 years since we saw ChatGPT introduced. And I wonder, what the next 3 years looks like, what the next 5 years looks like, how integrated some of these tools will be in our daily life when you think ahead in the future there.
So I think there is going to be a voice revolution. So right now it's still a lot of typing, but people are starting to convert to that voice side of it. So they're just asking more conversational type questions. So I think that's one area that you'll see change. The second thing that I'd say is they are going to improve. I think we're doing a lot more narrow AI in these. So you're going to see companies that really are, you mentioned travel, getting much more specific about what in travel they're providing. So you're starting to have that capability that's not boiling the ocean. So I'm just going to boil my tea kettle, to be the right answer for you.
I do want to circle it back to some of the earnings we just got, particularly with ARM and Qualcomm, because there's been a lot of talk about NVIDIA kind of eating everyone's lunch in the sort of advanced chip space. But we've seen some progress amongst other chip makers to try to catch up here. Do you think we're going to have a viable alternatives to Blackwell and some of these other high-end chips anytime soon?
I think that it's getting there, and it's a little bit different. It's not that those chips are getting that close, but that the demands are getting lower. So we're becoming more efficient.
Mm-hmm.
And so I do think they're going to cross at some point to where some of these chips can start having that impact. But NVIDIA's good.
Yeah.
I mean, they're relentless.
Yeah.
So,
but to your point, I mean, that's kind of what DeepSeek's argument was. I mean, obviously, there's a lot we don't know about what they did,
right.
But they claimed that, look, we were able to do a lot with a lot less.
Yes,
Yeah.
and I think you're going to see that,
Yeah.
and that's going to continue. We're technologists. That's something we like to do.
Yeah.
All right, a great conversation. Really appreciate your time. That is Jana Eggers. She is CEO over at Nara Logics. Now let's get back to that breaking news. We're keeping an eye on Pfizer after it lost a legal bid to block Novo Nordisk's $10 billion bid to acquire obesity startup Metsera. Bloomberg's Cynthia Kuhn, she leads our healthcare coverage over at Bloomberg News, sitting to my left. And Cynthia, what happens now? So Pfizer was unsuccessful in blocking this bid. Do they respond with another sweetened offer for this company?
Yeah, it's entirely possible. We all expected this to actually happen. Yesterday, the judge in the first hearing on this matter signaled that she thinks it would be better if it just went out to a bidding war. It's already a bidding war and it's already intensified. So I think most likely, they raise their offer. They maybe don't have to at this point because the FTC came out with a letter saying that Novo's deal structure, which is quite unconventional, may not actually work with some of the antitrust rules. So part of what this deal has brought up is Novo's offering to acquire 50% of the shares before the regulatory review is completed and pay out a dividend quite quickly to those Metsera shareholders. And that's raised the FTC to say, okay, we don't know if that's going to go forward. So right now, I think the Novo bid looks a little shakier, and whether or not, does Pfizer feel like it has to compete against itself if that's the case? I think that's probably the question they're weighing up right now.
I am curious, though. I mean, first of all, when is this review going to be done? And more importantly, I'll put this delicately, do we have a sense that this decision is going to be made about the fundamentals of the business, of the industry, or is it going to be more of a political decision that fits into whatever sort of narrative this administration is trying to concoct?
Well, already we've seen some interesting moves from the FTC. They cleared the Pfizer deal or gave early clearance last week when they haven't been doing any of that since the shutdown started. So that was a really surprising move. Mm-hmm. That gave Pfizer kind of the green light, you're in a good position. And Pfizer's been arguing they have the regulatory advantage over Novo in this situation because Novo makes so many more drugs in obesity, and this is all about obesity, and Pfizer doesn't have necessarily a big foothold there. So, the politics are at play. I think the reality with this actual bidding war is they keep having these 4-day clock and then a 2-day clock. So each bid signals a tight timeline for the next deal. Yeah. So it's really just going to come down to, I guess, how desperate any one of them gets.
All right, Cynthia Kuhn, Bloomberg healthcare reporter, a closer look at that potential deal with Novo Nordisk. Meanwhile, keeping an eye on the skies over the United States, the Transportation Secretary Sean Duffy speaking right now there on your screen, talking about a 10% cut in capacity at 40 airport locations as the government shutdown here in the U.S. extends for a 37th day. This is The Close on Bloomberg. Keep an eye on some of the big after-hours movers on the back of earnings, including Elf Beauty, Katie Greifeld. Those shares down 28%. In fact, it's one of the biggest decliners in the after-hour trade. The company's net sales in the most recent quarter missing. The company's adjusted EPS in the most recent quarter, well, that beat. But the guidance going forward, well below the average of street estimates. The company says look for revenue for the full year of 1.55 to 1.57 billion. That's below the average of street estimates.
Yeah, absolute wipeout you can see in Elf Beauty shares right now. But they're not alone because Duolingo down about 21% right now. Their fourth quarter bookings view actually trailing estimates. They see bookings in a range of $329.5 million to $335.5 million. Analysts, on the other hand, had been expecting about $344 million. So a big disappointment there. You can see that in shares. TKO also down about 1%. Some good news there from Lyft, though, a little bit higher right now after it reported earnings as well. Fourth quarter gross bookings about $5 billion to $5.13 billion. That's your snapshot there. Let's get back to Snap earnings, though, because Snap shares are soaring right now. They reported earnings moments ago, but the bigger news, perhaps, is that they're going to partner with Perplexity to bring AI search capabilities to Snapchat. Taking a closer look now is Mandeep Singh of Bloomberg Intelligence. So Mandeep, you look at shares up 23%. How much of this is numbers versus that partnership with Perplexity?
I would attribute it more to that Perplexity partnership simply because, the best way to frame it is this is all going towards gross profit. So right now, Snapchat is a 55% gross margin business. This all goes to that, gross profit line. And the reason for that is very simple. Perplexity, I think, wanted to buy a browser first, and now they are trying to partner with any of these social media companies. I would say even Pinterest is on the table now that we have heard something like this could happen. So clearly they're trying to leverage the distribution of Snapchat, and the $400 million is a sweet deal for Snapchat, given they don't have to spend anything on compute and they are getting that money flowed through gross profit.
I am curious, though, do you think this is going to drive either, more users to the platform or at least greater engagement amongst the current slate of users?
I mean, right now you've got, real risk of AI-generated content from OpenAI, Sora, or, any other platform really hurting the time spent on these social media platforms. I think that was my takeaway from Pinterest earnings last night, that engagement is getting impacted by AI content. So adding a Perplexity is, Snap's way of keeping people on the platform more, even though it's a separate tab in the app. If you're doing messaging, you do that, and then you go to that tab where Perplexity chatbot is available. And Snap tried to do that with My AI chatbot on their own, but that didn't really drive engagement. So the hope is Perplexity will drive more engagement, and in the end, they also end up getting paid for that.
All right, Mandeep Singh of Bloomberg Intelligence. Take a closer look here at those earnings out of Snap, the biggest performer in the after-hours trade as we await that company's conference call. But as we work through those numbers on Snap and talk about social media, some of those social media companies need to prepare themselves. Thousands of plaintiff complaints out there, millions of pages of internal documentation, and transcripts of countless hours of depositions set to land in U.S. courtrooms that could threaten the future of the business model for some of those social media companies. That is the focus of a new documentary released on October 30th called Can't Look Away, the case against social media. It's now available on Bloomberg platforms, and it exposes the real-world consequences of harmful algorithms. I'm pleased to say that the co-directors of Can't Look Away join us here in Studio 2, Matthew O'Neill and Perri Peltz. Great to have both of you.
Thanks for having us.
I wish this was a more happier topic to talk about, but I think all of us with kids have sort of looked at social media and really sort of asked ourselves, what are we giving up here? When I watched this investigation, the main thing I was struck was just how much documentation is out there already about some of the harmful effects. Why hasn't there been any change yet?
You want to talk about the change a little bit?
Sure. I think that change is hard and long coming. And Section 230, which you've probably talked about a lot on this show, of the Federal Communications Act of 1996, essentially protects these social media companies from lawsuits. However, what you'll see in the film Can't Look Away, and interesting that you were just talking about Snap, is that one of the main arcs of this story is a lawsuit that parents bring against Snap because of harms that their children suffered linked to their use of Snap.
And that is progressing right now because that is in the system right now. They are in discovery, and the lawyers are getting lots and lots of documentation that they hadn't had access to before. So we're expecting real change to happen in short order.
For the folks that you have, and I'm talking about the parents and some of the kids that you talked to in this piece, what is their general sense here as to their ability to, I guess win isn't the right word, but I guess get some sort of a justice or compensation for what happened?
It's a great question. Right? We know that these parents are doing this because they want to make change. They don't want to have happen what happened to them to other families in this country and around the world. However, even with the victories that they're having step by step, it doesn't bring their kids back. So I think it's a real double-edged sword in terms of progress that they're able to make and what it's not able to do for them.
So, as you mentioned, I mean, the perspective that change is coming, but even still, I mean, it feels like technology, social media, it advances every single day. I mean, we were just breaking Snap earnings. They're announcing this partnership with Perplexity AI to bring that search onto their platform, and it's just another avenue in which, you know, these apps become more and more a part of those younger users' lives. So, I mean, how do you sort of outrun that if regulation can't quite keep up with it?
Well, you can't outrun it. Regulation, legislation is never going to move as fast as technology. Litigation, no matter how strong our civil justice system is never going to move as fast as technology. However, what does shift is culture. And a lot of what these parents are fighting for, whether it's trying to hold Snap accountable or any of the other social media companies accountable for harms to young people, is change in the way these platforms work, change in the way these platforms are allowed to engage with young people. And how that occurs, whether it's because there's outside enforcement from the legal system, like in Australia or the United Kingdom, or it's because kids won't use the platforms.
But is it going to be too late? I don't want to make this too personal, but I've got a teenager at home, and this is something my wife and I talk about all the time. And I've seen parallels being drawn now to what eventually happened to big tobacco and maybe what happened in pharma. But that was after millions of deaths and countless other maladies from those incidents. And do we have to get to that stage before we get the real change?
Unfortunately, there are real parallels with tobacco and with the opioid industry in that these companies know what they're doing. We see that from the internal documentation, and you see that in the film. Do we have to lose the number of lives that we did in both of those epidemics before there's real change? We're really hoping not. This seems to be on a faster trajectory, and there seems to be more outcry from parents, from teachers, from aunts and uncles to make real change. So we're hopeful.
Well, continuing, those parallels to the tobacco industry, to the opioid industry as well. I mean, how do you make sure that some of the change that's being talked about is lasting? Because something that we see in social media and these apps all the time is that, what's hot today isn't necessarily going to be the app of tomorrow. Certainly Snapchat is stuck around for a while, but you could see something coming up in the pipeline that could rival a TikTok, for example. So how do you make sure that, whatever is being enacted is going to be sustainable and lasting?
Well, I think that sense of sustainable, lasting change is probably about holding these companies accountable. Again, this Section 230 that keeps them from being held to justice in the civil justice system is where these companies are protected. So without that changing, there can't be real lasting change for internet service platforms or social media companies. So there is one sort of skeleton key that could lead to anything coming down the pipeline having the ability to be held accountable, including these new artificial intelligence-driven apps.
So what do parents do in the interim? Those who have kids and whose kids are now reaching the age where social media will be a part of their lives, whether the parents want it to be or not?
Yeah, thanks for asking that question, because what we hate to do is scare everybody and then not give them anything that they can actually do. The most important thing is there has to be limits on the use of these phones and these apps. And the best way to do that is to delay giving your child these apps, the ability to get there. So hold back on giving phones and have conversations with your kids. Oftentimes we as parents think, well, how can we have these conversations? We don't understand social media like they do, and we don't. But we need to keep talking about it. We need to keep these devices away from them for as long as we possibly can, and we need to see changes in the school.
All right, well, that's a good note to leave it on. Really appreciate your time. That is Matthew O'Neill and Perri Peltz, co-directors of Can't Look Away, the case against social media, an original investigation now available on Bloomberg platforms. Meanwhile, we turn our attentions back to the after-hours trade, certainly sorting through plenty of earnings here. We have Qualcomm now unchanged, which is interesting. A lot of volatility in that stock. We also have AMC up there as well, one of the many names reporting earnings after the bell. Their third quarter revenue beat estimates, you can see, being met with a little bit of enthusiasm. But then take a look at the bottom of the screen there. Elf Beauty down 26%. DoorDash now down 19%.
And we need to dive a little bit deeper into Elf. We should point out Coty also out with its earnings as well in the beauty space here, and really seeing pressure for some of these consumer discretionary names. This is The Close on Bloomberg. All right, let's talk Tesla. Tesla's 9th largest shareholder, that's Norway's largest bank, is voting against the EV maker's proposal to grant CEO Elon Musk a stock package that could potentially be worth $1 trillion. That pay package, a focal point of the annual shareholder meeting, as those investors are now having to vote on this big pay package. There's been a lot of questions, not so much just about whether he deserves that money, but about corporate governance of this company overall and the future control over it. So let's bring in a foremost expert on corporate governance. Charles Elson joins us right now. He's founding director of the Weinberg Center for Corporate Governance at the University of Delaware. Thank you for being here, Professor Elson. I know there's a lot of talk on the $1 trillion number, and it's easy to make fun of that. But ultimately, underneath the surface, this does seem to be much more about Elon Musk trying to regain control of the company that he had before he started, selling off all his shares for other ventures here. Is there a question to be had, not so much as to whether investors should be voting on this based on the pay package, but more so whether they should be making a decision based on whether they think that Elon Musk should have an outsized share and control of the company itself?
You're absolutely right. I mean, it's called having your cake and eating it too, in that he sold a lot of shares. He obviously took the money and bought Twitter with it. And yet he still wants to remain in complete control of the company, or a greater control that he has now, though one would argue his control now is pretty solid. I mean, the funny thing about this, you mentioned earlier the annual meeting. It's not really an annual meeting. Annual meetings take place basically from year to year. The annual meeting for this one should have taken place back this summer. And Tesla simply pushed it ahead. Typically, an annual meeting is within 13 months, most statutes, of the one before. This one is quite a bit longer. Why did they do it? Because they could. Was it the right thing to do? I don't think so. No, that's why they call it an annual meeting. They don't call it a meeting when we feel like bringing it to you. It's called annual. And so you kind of start with that, and it kind of goes downhill from there. The package is obviously enormous, but you're right, it's about control. And he's basically wants to have his cake and eat it too, in the sense that he sold a lot of stock, which most people do, and their ownership goes down. He wants it back, and he wants it back through this package. And I, as a shareholder, I think I'd be pretty wary of that whole thing. And that's obviously the Norwegian fund is, clearly.
Well, and forgive me too, so we can update viewers here too, because I mean, obviously this originally was put out there on the table. I think it was a smaller number, but still a sizable number. The Delaware court struck it down, and now this has been going back and forth through the courts. Investors have to midnight tonight to put their votes in. If they do approve this, is the court still going to have a say in whether to sign off on it, or is it a done deal?
Oh, no, because what happened was the court ruled, and on appeal to the Supreme Court, arguments were held a couple weeks ago. But what happened was he just said, OK, I'm moving to Texas. So he took the whole thing. The shareholders approved this, which surprised me, moves it to Texas. And under Texas law, it's very difficult to challenge this thing. So what happened, actually, you have two packages. Number one, the company itself re-awarded him the original package while in Texas. And then this is another package. This is a sort of the second bite at the apple, so to speak. So the other package that sort of gave him what Delaware had taken away back to him in Texas is around, and I think under Texas law, it's going to be almost impossible to challenge it. The Texas law is such that you can't bring a derivative suit to challenge it unless you have huge holdings, and very few do, and that's the problem. Secondly, this is something entirely new. That one gave him the money that he claimed he was owed, and this one is something entirely different, and that's the problem here, and that's the issue.
Charles, what also interests me is sort of seeing how much sway the proxy advisors have, because ISS and Glass Lewis, they've advised investors to vote against the package. We know that Tesla in particular has a very hefty retail following, but the last number I saw was that makes up about 30% of the shares. I wonder, how much of an impact you think that might have in some of the dynamics of this vote.
Well, obviously, the retail investors supported him last time in the last vote. Not all the institutions did. In the last pay package, the one that was the dispute in Delaware, I think he got about 71% approval. So the 29 who didn't, a lot of them were the large institutions. That's the issue. Secondly, the other problem is that in Delaware law, under Delaware law, that it's a put it this way, under Texas law, it's impossible to bring a suit. That's number one, or very difficult to bring a suit. But in Delaware, had this, come up again, the question would still be, were the shareholders appropriately informed? Did the thing comport with normal procedure? But today, it's in Texas. The institutions may oppose it, and he won't get a majority. But again, the retail investors seem to love him, and they seem to be, I think, a little bit oblivious to this. It's sort of the star factor. Well, the king can do no wrong. I support the king. The difficulty with that is it hasn't been a great year for Tesla. And to give someone this kind of package, given what's happened this year, I don't think would happen in an ordinary public company. The danger of this thing, though, if it happens here, it's going to happen somewhere else. There'll be another executive who will say, well, I'm a superstar, too. I'm better than he is. I want this sort of thing. And suddenly it's a house of cards that really affects shareholders. This isn't just about Tesla. Yeah. This is about the power of an executive, a controlling executive that affects the rights of every shareholder. And I hope the shareholders of this company think about it. It isn't just Tesla. It's everyone they've impacted. That's the danger, in my view.
So 2 points here. You take a look at Tesla shares. They're higher by about 14% on a total return basis. That is trailing the S&P 500, and we know that has come with quite a lot of volatility in 2025. But I want to pick up on that last point here, because in many ways, Tesla is unique. Elon Musk is unique. There is a very real premium that has been built into these shares just in the idea that Elon Musk is involved in this company and it commands his attention. Do you truly think that, we could see another situation like this one when it comes to some of the packages that are being bandied about and this particular shareholder base? Absolutely.
Absolutely. It's actually kind of scary because when you have this sort of control, there's no accountability with it. I mean, in a normal situation, an executive who left the company, CEO or chief executive officer, leaves the company, basically goes into something completely different for a year, creates all kinds of public relations problems for the company itself, then comes back and says, well, I will leave again forever unless you give me this money. It's bizarre in my view.
Well, Professor, I mean, even beyond that, I mean, there's also another proposal on the table that we haven't talked about, which is effectively investors giving Tesla the ability to invest in XAI, which is basically a completely separate private entity controlled by Elon Musk. That seems unusual to me.
Oh, I mean, people invested in Tesla because they thought he was going to take them into AI. And that was so what's happened now by setting this other entity that Tesla will invest in, you've even watered down again the potential returns that the shareholders of Tesla have. They thought it was all going to be in Tesla. And in fact, it's not. And he said, if you don't do this, I will set up a competing company and you won't have anything to do with it at all. Yeah. I mean, it gets a little strange. And that's where you got to wonder what the shareholders are thinking.
I think I asked this question of you the last time we spoke, and there are other proposals on this that are also kind of weird. Obviously, they're trying to sort of deal with the restrictions on shareholder lawsuits that Elon Musk was able to secure by moving to Texas. But it all raises the question, if this were a private company, we wouldn't even be talking about this. If he had majority control of a private company, everyone would just say, you know what, he can do whatever the heck he wants because he's the primary shareholder. Should this company be public?
I think that's a great question. I mean, look, Twitter, he, basically completely owns Twitter, from what I understand. And frankly, if you own it yourself, you do it with what you wish. But the problem is when you take on public shareholders, your obligations change because you have an obligation to them. There has to be accountability to them. And you can't operate a public company like a company where you own 100%. Yeah. Look, if you own 100% of it, you can buy the worst piece of art you'd like for the company, stick it in the front hall, and it's your money. Right. But if you take on other people's money, that's where we change. And
All
that's
right.
the problem here.
Charles, got to leave it there. Always a great conversation. Appreciate your time. That is Charles Elson. He is founding director of the Weinberg Center for Corporate Governance at the University of Delaware. This is The Close.
A busy day that could get busier over the next 24 hours. The markets have their eye on more earnings, including in the morning out of Tapestry, Moderna, Warner Brothers Discovery, and your favorite, Papa John's.
Excited to hear commentary from Papa John's reporting that Apollo withdrew its bid to take the company private. Then after markets, Airbnb, Expedia, DraftKings, Sweetgreens, Open Door. The list goes on, Romaine.
And of course, we have a big decision out of the UK on rates, Challenger job cuts at 7:30 a.m. And then Tesla, we were just talking about it. The deadline here to make that vote is midnight tonight, and the results expected to be announced at some point tomorrow.
This is The Close.